Hi, it's Carl Allen again, and welcome to Module 2, Lesson number 3 of Dealmaker Empire. So today is all about the synergies, or the cost savings that you will benefit from when you acquire another business and you combine it with what you have already. And this is the remaining part of the first leg of the perfect deal triad. And after this, in lesson number 4, I will show you how to craft the perfect deal specification, which will act as your guided laser through deal origination. And whether you're acquiring a competitor, a supplier, partner, customer, or a complementary business to enter a new market, there are always financial synergies that come from a bolt-on acquisition. As with lesson number 2 on cross-selling, you will not be able to do the detailed work today on this because you haven't found a deal yet, and therefore you don't have the data to run this analysis. However, like last time, I want to walk you through the process for later so that you will know what to look for when you start deal origination in the next module. Now, financial synergies fall into two sets. The first synergy is the economies of scale that you will get across all of your buying. So this is not overhead, this is your cost of sales. So if you're selling products, it's the cost of sourcing them or the cost of the raw materials before you manufacture them and sell them. It's the total cost of what you're bringing in before you sell it. For services, it's the same process. To deliver a service to a customer, there's a cost associated with it, even if it's just your people. Now, the second synergy is your overheads. Combining locations, reducing headcount, the owner's salary and benefits that will not be paid by the business post-closing, R&D, general and admin, insurance, marketing, everything, all the overheads. Now here's the financial synergy model, and you can download it below. And you're going to need it to do the detailed work later. So let's work through the cost of sales example. Now these are the cost savings that you will generate as a larger business. And as you know in business, the more stuff you buy from suppliers, the bigger the discount you can receive. It's basic economics. So when you combine your purchases, the purchases of your target business and the purchases that will be generated from the cross-selling, you need to estimate what buying volume discount that you can generate. So the easiest way to figure this out, and we get into this more in detail in module number 5, is just to call the suppliers and ask them if you at least double your current business with them, which you're likely to do through a bolt-on, could you get at least a 5% to 10% discount or higher in some cases. So in this example, if you only received a 5% discount on all of those purchases, all of those cost of sales, this would save you over $485,000. And remember, the value of a business is a multiple of its profit. So even just applying a 5 times multiple to that $485,000, it's increasing the value of your entity by more than $2 million just by getting a measly 5% discount on your buying. And that's why bolt-on acquisitions are so powerful. So in our example, the total sales across both businesses plus the cross-selling total more than $14.5 million. And the total purchases to generate those sales revenues are more than $9.7 million. So the final net spend of just over $9.2 million with the 5% savings. And now the entire $485,000 is all operating profit. So it all adds to your EBITDA, the profit, the cash flow. That's what gets multiplied for valuation, and where one of the boosters of value come from a bolt-on acquisition. Next, we need to look at all the various components of the overhead. Here's the full sheet from the model, but I'll walk you through it in chunks. So overhead is broken down into 6 key categories. There's research and development, R&D for short. There's also employment costs, the owner's costs, which, as you know, we like to break out. Next is site and establishment costs, where the business is trade, sales and marketing, then finally general and administrative costs. So let's look at each category. So the goal here is to identify duplicate costs when you combine the two businesses together. So if the business does R&D, especially if you're in sectors like IT, manufacturing, telecommunications, engineering, pharmaceuticals, etc., then there may be redundancy in common new product development, particularly patent costs. If both businesses are paying for patent advice and legal services, then that's a cost synergy that can definitely be made. There might even be some dedicated and redundant employee costs for managing those patent portfolios. Employee costs are another massive area of cost savings. Now, as you know, you can't mass execute employees in a bolt-on because that's not how we're doing those deals. But as I mentioned before, 10% to 20% of the employees will inevitably leave of their own accord anyway. And if you don't need to replace them, then that can be a major cost saving. And there's also the related benefits to those employees, which could be cars, healthcare, retirement funds, travel and other expenses, and taxes or insurance that you as the employer have to pay for these people. Then there's the owner's costs, which are arguably the biggest and most obvious savings. So his or her salary and bonuses, so when the owner comes out of the business, you're going to save all that money. And what you'll also find in small businesses, it's actually quite funny, is the owner's family members are sometimes employed and paid. But you never see them anywhere in the business, apart from the photographs on the owner's desk. It's just part of the wealth sharing. I do it in my businesses for my wife. She's never set foot in any of my businesses, but she's on the payroll because it's just a tax efficient way for us as a family to take money out of all the businesses that I own. And all these costs obviously will come out as well. And when you look at what business owners extract from their businesses in terms of benefits for them and for their spouses and their children and their brothers and their sisters, and all those different people, all that cost comes out. A business owner I once met, and this is a really funny story, he had the cost of his pets in the business because he justified it to his accountant that it was part of his site security. He put all of his holidays through the business. He even had a boat because he said he would answer phone calls and do emails on his boat. So he justified that as a legitimate business expense. So all this came out in due diligence, of course, but this is an example of all the massive savings that can come through doing these deals. And you can eliminate things like owner insurance. It's called key man insurance in the UK. You've probably got that for yourself in your business. So if the owners of the target business have also got it and they're coming out, then you can cancel their insurance and save the money. Site and establishment costs are also a big part for savings, especially if you're consolidating operations. So you're either moving your current business into the target business location, if it's larger, or vice versa, or you move out of both and find a central, more appropriate set of premises. And in all cases, you will save on all the duplicate costs for rent, rates, taxes, insurance, maintenance, utilities, and other costs like security, whether there's dogs in there or not. In sales and marketing, there'll be duplicate marketing activities. Both businesses may be going to the same events, doing the same advertising and the same social media. And you can also save on things like commissions and bonuses for the salespeople. And in the general and administration category, you can save on things like advisor fees for accountants, CPAs and lawyers. The point of all this is that you only need one, not two. If they're duplicated, you can take them out. So in the model, for each of the 6 categories, you need to list up to 5 elements of that overhead category. Then when you combine the total spend across both businesses, you can identify what savings can be made and calculate it as a percentage of the total. So let's say in employment detail 1, that's just the basic employee salaries. The combined cost is $1.15 million. Yet 20% of the employees will elect to leave and you don't need to replace them. So let's say one's in accounts receivables. So you only need one. One's in HR. Again, you only need one HR person. So you get the picture. The 20% total saving generates $230,000, and across all 5 elements, the employment costs have a total saving of $320,500. Do this in the model for all 6 categories, and then what happens is the model works out the total overhead synergies for you. So in this example, which is pre-populated into the model, the total combined overhead is just under $3 million, and the total saving is $642,000, or 21.6%. But take note, it's not all going to happen right away. You need to look at this as a 12-month project. The cross-selling volumes will be based on you ramping up all those sales and all those volumes over the full 12-month period. Although a lot of the cost synergies will be instantaneous, you need them to flow through the business and flow through the income statement for a full 12 months to see that full annualized benefit and the ultimate increase in the profit, the valuation, and ultimately your net worth. So now let's look at how all this feeds into the summary tab of the model and ultimately the valuation. So here's the full sheet. Let's break it down. So the current business is doing $7 million in revenues. The target business is doing $5 million in revenues. And we're projecting $2.6 million in total cross-selling revenue. So that's a total of $14.6 million in revenues with a blended 37% gross margin and a $9.2 million total cost of sales, which includes the $485,000 5% cost saving. So the total gross profit is then $5.3 million. So next is the overhead summary. So the current business's overhead is $1.8 million. The target is $1.2 million, and we've identified $642,000 of savings or synergies across that combined entity. So the net total overhead is now $2.3 million, and when you roll it across the next 12 months, and as you can see how it totally turbocharges the valuation, and we've been really conservative. We've identified a bunch of products we can sell to new customers, applied a 40% probability, took out some overheads, and applied a small 5% discount on our $9 million plus cost of sales. And just look at what happens. So the current valuation of the business, our own business, is just over $2.3 million, which is 5 times the $465,000 worth of EBITDA or profit. So for the target business, the sales are smaller, but the profit is higher. So it's worth more, just under $3 million, which is 5 times its $597,000 of profit. So the total profit, when you add in all the cross-selling and you add in all the synergies, the cost of sales synergies and the overhead synergies, now jumps up to $3 million as a combined entity. And 5 times that is just over $15 million as a new valuation. You'll be able to acquire your target business for less than 5 times, and your selling multiple will be higher than 5 times as a larger entity. So the valuation shifts will be much greater in reality, but I've kept all the multiples in this example at 5x for simplicity. So the current business is worth $2.3 million plus the target business is $3 million. So total is $5.3 million. And we're looking at almost a 3 times hike in the combined business's value up to a little more than $15 million. So for you as the acquirer, you're looking at a 6.5x value bump, 2.3 million to 15 million, or a 546% return on investment. And although you will do this detailed work in module number 5, once you've found a business, met the seller, and you have the data to do the work, I really want you thinking about this now in advance of creating your deal specification and also for the deal origination work in module number 3. So different products and different services to sell to your existing customers and vice versa. New channels to market so you can exploit, and lots of duplicate costs and inefficiencies you can benefit from in terms of financial deal synergies. What weaknesses and threats do you have in your business that an acquisition can solve? And are there big opportunities facing you that you can exploit faster with an acquisition? And now that we've covered the various components of your deal strategy, it's time for you to craft that perfect deal specification. What type of business do you want to buy? Why? And what does it look like? And just as important, what doesn't it look like? I will see you next on lesson number 4. And until then, bye for now.